Hello, I'm Professor Brian Boucher, and welcome back. This is the second video of the first part of the case. We did 7 transactions last video, 7 more to do this video. Let's pick up with transaction number 8.
On June the 30th, Park paid $700 for a site license to use geocontour mapping software in the metal detectors. The license was good for 3 years with $700 due to be paid annually, that is, the total cost over 3 years will be $2,100.
Okay, let's look at the journal entry here. In this case, we are paying cash. We paid $700 of cash. Cash is an asset. We make an asset go down through a credit, so we credit cash for $700. Now, what are we paying for is we're buying software. And I never knew that metal detectors ran on geocontour mapping software, but apparently they do. Software is going to be an asset because it's something that we can use to run these metal detectors over the next 3 years. But we don't account for all 3 years of $2,100 now. We only account for the $700 that we paid in cash.
Excuse me, I hate to sound like a broken phonograph record, but why is this an asset and not an expense?
This could probably go either way, but I like it as an asset because I want to match the cost of the software to the rentals that it facilitates, which are going to happen more than just in this period. But we'll talk about this more when we do adjusting entries and amortization later on. To post this one, we create a software T account where we're going to put the debit to software, and then we put the credit to cash at the bottom of our ever-growing cash T account.
On June the 30th, Park signed a contract with a local advertising agency to provide various forms of advertising for a period of 1 year. She paid $8,000 upfront for advertising through June 2013.
For this journal entry, we are again paying cash. We're paying $8,000 cash. Cash is an asset, goes down with a credit, so we credit cash $8,000. Hopefully at this point you could be crediting cash in your sleep because we are doing it quite often. What are we getting for this cash? Well, we're getting a year's worth of advertising without having to pay any additional cash. That's an asset. It's a future economic benefit, so we're going to create an asset called prepaid advertising. And since it's an asset, we increase it with a debit of $8,000.
Do we also get to record the value that this advertising will create as an asset? I mean, this advertising could bring $10,000 extra to the bottom line. Sounds like an asset to me.
It's important to note here that the asset is only for the cost of the advertising that's been paid in advance. It does not represent the potential value that the advertising will bring the company. That potential value can't be an asset because accountants judge that the amount of those benefits cannot be measured with a reasonable degree of precision. There's too much uncertainty about how much value it's going to bring, so we don't book that part as an asset. So to post this one, we have yet another credit to cash for $8,000, reducing the balance in that account, and then we create a T account for prepaid advertising.
On June the 30th, Park needed cash to make a payment on the Imperial Bank loan that funded her purchase of Relic spotter stock. She borrowed $5,000 from Relic spotter at 10% interest, with the principal and interest due in a lump sum on the 30th of June 2013.
This journal entry is a little complicated, so let's think about what's going on. Relic spotter is paying $5,000 cash to Rebecca Park. So anytime we're paying cash, cash is going down, cash is an asset, we make it go down through a credit. So Relic spotter is crediting cash for $5,000. Now we need to find the debit. So what is Relic spotter getting from this? Well, essentially, they're making a loan, so that's an asset because they're entitled to get $5,000 back from Rebecca Park at some point in the future. So we want to debit an asset to increase an asset. We're going to call it notes receivable. Debit notes receivable $5,000 to increase the asset. We don't want to call it accounts receivable. We only use that for customers We're going to call it notes receivable to reflect the fact that it's a loan.
Hey, wait a minute. The last time Park borrowed money for herself, we didn't record it in the company's books. Yes, is this another trick question?
You're right that in both cases, Rebecca Park was borrowing money on her own account. What's different in this case is now Relic Spotter is loaning the money to Rebecca, which means Relic Spotter is giving some of its money, which means that it has to be recorded as a transaction for Relic Spotter. And you didn't ask this, but the interest that we're going to earn on this loan as Relic Spotter does not get booked now. It'll only get booked as the money's outstanding over time. And to post this one to T accounts, we put yet another credit in the cash account, and we create a notes receivable asset account, which is a debit balance of $5,000.
On June the 30th, Park also hired 2 employees, Linda Carlisle and Charlotte Caffley, to run the shop. They signed employment contracts promising each salaries of $32,000 per year.
So for the journal entry here, we actually have to stop and think about, is there a journal entry? Has there been any transaction, any exchange of cash, goods, and services? Do we actually owe Carlisle and Cafferly any money? They haven't worked for us yet. So just signing contracts, this is the kind of promise that we don't account for. And so there's going to be no journal entry for this kind of employment contract. Either they have to work for us or we have to pay cash before we're going to record any journal entry. We just don't account for these types of promises.
So here's your trick question. Where I come from, when you promise something, it becomes an ironclad obligation. So, when isn't this a liability?
I'm sorry to cause so much stress, but we did talk about this in the liability video. Remember, one of the criteria is that the obligation has to be based on benefits that we've received currently or in the past. We haven't received any benefits from them yet because they haven't worked for us yet. In fact, they could quit immediately and it's not clear that we would owe them anything. So it's not until they work for us without being paid that there can be a liability.
On June the 30th, Gerard called from Santroff Pay to check in on the business. Upon hearing that Relic Spotter only had $47,200 of cash left in the bank, Gerard became concerned about his investment.
Let me jump in here before the narrator continues the question. The way that we would know Relic Spotter has $47,200 of cash in the bank is at this point we could draw a line and figure out the balance in our T account. So if we take the initial debit, subtract all the credits, there's a debit balance of $47,200, which should match what we would have if we called the bank and asked for our balance. Okay, back to the question.
Thinking fast, Park stated that she was so confident of Relic Spotter's prospects that she was declaring a 10-cent per share dividend, to be paid on August the 31st. This dividend seemed to reassure Gerard.
Okay, is there a journal entry here? Well, we talked about this in a past video that when you declare a dividend, you actually make a journal entry at that point. So even though the dividend is going to be paid August 31st, on June 30th, it's declared. So once it's declared, we need to take that dividend out of retained earnings. Retained earnings is a stockholder's equity account. We reduce a stockholder's equity account, which has a credit balance, with a debit. So we're going to debit retained earnings, $2,500, to reduce the stockholder's equity account. The other side of this, again, as we had mentioned in a prior video, is that once you declare a dividend, essentially you're holding the cash that belongs to the owners until you actually write the checks. So you have this obligation to eventually write those checks. That obligation is treated as a liability called dividends payable. We make a liability go up with a credit, so we're going to credit dividends payable, a liability, $2,500.
Whoa. I thought you said liabilities were obligations to non-owners. The dividends are owed to the owners. How can you possibly justify having a dividends payable here? And how can you record dividends on the date they are declared? I thought you said that we don't account for promises. Wouldn't it make more sense to wait until they are paid?
We had talked about this one in a prior video also, and I agree it's not very intuitive. You're just going to have to take my word for it. by convention, when we declare a dividend, that's when we take it out of retained earnings, even if we pay it later. And at that point, our owners become creditors because we're holding the cash of their dividend until we send them the check. So just memorize this. You declare a dividend without paying it, debit retained earnings, credit dividends payable. Post this to T accounts. We're going to put a debit to the retained earnings T account and a credit to dividends payable.
What? How can retained earnings have a debit balance? According to my notes, it is a stockholder's equity account and should have a credit balance.
Wow, you've been taking notes? That makes me feel so good. Yeah, you're right that retained earnings is a stockholder's equity account, usually has a credit balance. But retained earnings is the one account that can either have a debit or a credit balance. To make the balance sheet equation balance, assets equals liabilities plus stockholders' equity, we need one account that can either go debit or credit. Because if you had more liabilities than assets, you basically need negative stockholders' equity in terms of retained earnings. If it is a debit balance, we often call it something like accumulated deficit rather than retained earnings.
Relic Spot opened for business on the 1st of July 2012, just in time for the big Independence Day weekend. On July the 31st, Park paid the supplier the $2,000 it was owed.
So for this journal entry, we're paying cash. We're paying cash to the supplier. So we pay $2,000 cash. Cash is an asset. Assets go down through a credit. The debit here is that we're paying what we owe the supplier. What we owe the supplier is accounts payable, which is a liability. If we're paying the supplier, the liability is going down. We make a liability go down through a debit. So we debit accounts payable to reduce the liability, to get rid of the obligation, $2,000.
I think we actually understand this one. Go on.
So we post this one to T accounts, yet another credit to cash, and a debit to accounts payable. And notice if we figured out the balance in accounts payable now, it would be zero, which makes sense because we've paid everything we owe to the supplier. We don't owe the supplier anything more. There can't be a liability. The balance goes to zero.
On August the 31st, Park paid the $2,500 dividend that had been declared in June.
For the journal entry here, we are paying cash. Cash is an asset. Assets go down with a credit. So again, we credit cash for $2,500. The debit here is going to be dividends payable. We're paying off what we owe the shareholders for the dividend. We created a dividends payable liability for that before. We make a liability go down through a debit. So we debit dividends payable to reduce that liability by $2,500.
Excuse me, so, it looks like every time you pay cash to settle an obligation, you debit some payable and credit cash. Is that correct?
Yes, that's exactly right. Every time you pay a liability, you're going to debit the liability and credit cash. It's starting to sink in. Post this to T accounts, yet another credit to cash. At some point, we're going to have to start getting some revenue and getting some cash coming in because we seem to be doing nothing but spending cash. And anyway, a debit to dividends payable, which again zeroes out this account because we don't owe the shareholders any more money based on these dividends. And that's a wrap for the first part of our case. Next video, we'll start learning about revenues and expenses so we can start generating some profits for this company. I'll see you next time.
Excuse me, see you next video.